morning, everyone. Yes, thank you everyone for joining today on your busy schedule. So the thing what we're going to look at today is on the next phase of Indian equities and how should investors should position for the upcoming 2026, which means like probably the next 6 months, right? So yes, let's start right now. So, see, before we discuss on how investors should position themselves for the next phase of the market, let's first understand where the Indian equities stand today, right? Markets don't move based on single factors. They are influenced by a combination of different stuffs like valuation, liquidity, economic growth, and corporate earning. And at this point in time, while the long-term story of India remains more steady and more intact, the short-term environment has become more selective. Yes. If you see, rather than the broad-based rallies, markets are now reacting to more like data-driven stuff like the earning quality, the capital flows. Let's look at other stuffs also like right now this recent FIF flows and so. So we can go on a slow and steady phase manner. Let's understand what's happening, right? So let's talk about Nifty 50 right now. As you see, the index is around 23,548 as of May closing. But right now, if you see, it's around 24,000, which is approximately around 9.5% below its recent high as of May 2026. So many investors look at the correction and immediately think something's wrong with the market. But the corrections are actually a normal part of every bull market. They help to remove the excessive optimism, bring valuation back to a reasonable level, and create opportunities for disciplined investors. And we have seen this repeatedly throughout the market history. Yes. Instead of asking whether the market has fallen, investors should ask whether the long term growth story has changed. And today the answer is largely no. India's structural drivers like the rising consumption, manufacturing expansion, the digital transformation, and increasing formalization of the economy. So this everything continue to support the long-term wealth creation. Second, the thing is about liquidity or the market flow, we can say. One interesting trend this year has been the difference between the foreign and domestic investors flow. The FBI, you can say like that. So they have withdrawn more than 26 billion US dollars. This is like largely being driven by global uncertainty, interest rate expectation, mainly currency movement, geopolitical development, and change in capital allocation across emerging markets. However, see, despite this foreign outflow, the Indian market has remained relatively more resilient. The reason is the strength of the domestic institutional investors, the DIAs, who have kind of invested more than 41 billion US dollars year to date. This reflects a structural change in India's investment landscape. Yes, if you see the increasing SIP flows, pension funds, insurance companies, heavy participation in the equities, and the retail participations are also providing a strong domestic cushion. Unlike a decade ago, if you see, Indian markets are not entirely dependent like as like a year ago or like a 10 years back, if you see, we are not in the same situation right now. We are not now entirely dependent on the foreign capital because domestic savings have become more significant stabilizing force right now. Which main thing more than that is it helps to reduce the market volatility as we are not something like the country like Korea where you can see the index itself is moving 10% up or 8% down in day-to-day basis. Yes, now we can come back to our point. The third point is the economic growth. India's economy continues to remain one of the fastest growing major economies globally. While global, while the GDP growth is expected to moderate from around 7.7 to around 6.5 on FY27, it's important to understand the context. A moderation does not mean weakness. In fact, if you see, growth above 6% remains extremely healthy compared to most developed economies. Also, if you see, most of these developed economies are growing below 2% only. So this moderation simply reflects a normalization after a period of exceptionally strong expansion, what we have seen like last 3 to 4 years. As investors, we should focus less on whether the growth is 7.7 or 6.5, as we should be more focused on the thing on India continues to generate sustainable economic. So it will generate, it generates a sustainable economic activity. So yeah, guys, so the answer is very positive if you see the strong infrastructure spending, government reform, manufacturing initiatives like the Make in India and continued domestic demand continues to support the long-term economic outlook. And now let's look at the corporate earning, which ultimately drives the stock price over the long term. In the individual basis, I mean. See, over the last few quarters, we have seen earnings growth moderate. The PAT has slowed down to around 5% year on year. And unless the revised earning exceptions, kind of learning expectations downwards for several companies, if you see. This doesn't necessarily indicate a kind of a market downturn, but it does suggest that investors need to be more selective. In previous years, if you see, almost every sector participated in the rally. Going forward, market are likely to reward companies that are consistently delivering a strong earnings and having a healthy cash flow and a sustainable business model. Yes. So stock selection and quality will therefore become much more important than simply participating in the overall market, I would say. So if we bring these four factors together, what picture emerges is that we have a market that has corrected from its high and it's now being supported by exceptional strong rally by this domestic equity. Where, sorry, I mean domestic participants, the DIS, which are kind of standing as a big force for this against this FIS what's been taking place. But facing some short-term pressure from the lower earning growth and the cautious investor sentiment. That also we need to be taking into mind. So this all tells us that we are not in a peak market as a whole, I would say. We are just in the transition phase. The easy gains from the easy gains what we saw from the broad market rallies may be behind us for now. But the next phase are likely to reward disciplined asset allocation, selective investing, and patience rather than this aggressive risk taking, I would say. And that naturally brings us to the big next question on how should you position in this next phase of Indian equities. So in my upcoming slides, we can have a much more deep discussion about this. So now that we have understood where the Indian markets stand today, the next logical question is that where the opportunities are within the market. One area that deserves attention is the large cap companies. I want to make one thing clear that we see this slide is not suggesting that everyone should immediately invest in the large cap. Rather, it highlights an interesting valuation trend that long-term investors should have while making some good informed portfolio decisions. Okay, right? See, let's first understand what is the tables actually showing. See, instead of looking at stock prices, it looks at the market capitalization allocation. In simple terms, it tells us what percentage of the total Indian stock market is represented by large cap, mid cap, and small cap companies over the different periods. If you see historically, over the last 5 years, large cap companies have accounted for around 64.8% of the total market capitalization. However, as of May 2026, if you see, the market share has come down to 58.7%, creating roughly a 10% discount compared to its historical average. At the same time, if you see the mid cap and the small cap companies are trading at a premium to their long term averages. So this tells us that over the last few years, investors have shown a much strong preference for smaller companies, while large caps have been relatively ignored, I would say. Now, what is this kind of? Now you can look at this angle. Why this is very important. Let me explain with a simple example. Imagine there's a well-established supermarket in your neighborhood. It has been operating successfully for decades and it has a good regular customers, loyal customers. So it makes consistent profits and a strong reputation brand up. One day, due to temporary concern or changing consumer sentiment, the supermarket announces a 10% discount across all products. Not because the quality has deteriorated, but because demand has softened temporarily. Many people would see this as an opportunity to buy product at better prices. The same principle often applies to equity markets also. Sometimes the price changes faster than the quality of the underlying business. A stock or a group of companies may become cheaper not because they have become weaker business, but because investor sentiment has shifted somewhere else, like that you can keep. This is exactly what we have witnessed over the last couple of years. Investors' enthusiasm, if you see, has largely been concentrated in the mid cap and small cap stocks, where many companies deliver exceptional returns. I agree. But naturally, as more money chase these segments, valuation also gets expanded. Meaning that several fundamentally strong large cap businesses, companies with proven management teams, stable earnings, strong balance sheet, and established market position did not participate at the same extent. As a result, the relative valuation have become more kind of attractive, I would say. And another reason why large cap deserve attention is their resilience. Yes, during the periods of economic uncertainty, market correction, or global volatility, investors often see business with predictable earnings, strong cash flows, and a market access to the capital. Large cap companies generally possess these characters, right? But they are usually leaders in the business also. If you see any big business, the large caps will be still the top or the leaders in that particular scale. And this doesn't mean they are like risk-free in every sentiment of the market, but they often provide a greater margin of safety compared with the rest of others, right? So, however, if you see, it's equally important not to misunderstand this message. Discount alone should never be sole reason to invest. There are times when assets become cheaper for valid reason, and simply because something is trading below its historical average does not automatically mean that guaranteeing a superior future returns. Investors should always evaluate other stuffs also, like seeing the fundamentals like the business quality, earning visibility, competitive position, valuation, and whether the investment are aligning with their own financial goals and risk appetite. It's very important. And what this slide is really telling us is that, see, risk reward equation is large cap has improved compared to where it has been a year or two ago. Because that's what the data is saying, right? And if someone is constructing a long-term portfolio today, it may be worthwhile to revisit the segment with a fresh eyes instead of focusing only on areas that already delivered a significant gains, I would say. So if you see as a whole, the thing is that the market has created an interesting valuation opportunity in an asset class that many investors are overlooked. As disciplined investors, our job is to not chase what most popular. It is to recognize where the quality businesses may be available at more reasonable valuation. And that's what exactly what this data is encouraging us to think about. So one question that almost every investor asks whether kind of see whenever the market falls is foreign investors are selling. Should I be worried? Yes, right. It is very natural concern because FII activity often makes the headlines. Every day we hear about billions of dollars flowing in, out, and it keep on coming on a day-to-day basis, right? And every day we hear about billions of dollars stuff like this. Many investors assume that is FIs like if FIs are selling, the market cannot perform well. But history tells us a very different story. If you look at this slide, you will notice that over the last 2 decades, India has experienced several periods of significant FI outflow. If you see during the global financial crisis, the US credit rating downgrade, the COVID-19, the NBFC crisis, and even the recent this geopolitical concern, foreign investors sold aggressively. At that time, the market sentiment was extremely negative, and many believed the correction would continue for a longer time. However, what happens after that? That's the thing. In 9 out of 10 instances, the Indian equity market recovered like it delivered a positive return within the next kind of a year from the market bottom. In some cases, the recovery was even stronger than expected. The main case would be the COVID-19. Markets went on to generate exceptional return. This tells us an important lesson. FII sellings and long-term market performance are always not the same thing. Now, does that mean FIA flows are not important? Of course, they are important. But in short term, heavy FIs kind of selling and create volatility, increase the uncertainty and put pressure on the stock prices. But as we discussed in our first slide, today the India's market is very different from what it was like 10 or 15 years ago. Domestic institutional investors, mutual funds, insurance companies, pension funds, and the millions of SIP investors have become strong source of liquidity for the Indian market. So the growing domestic participation has reduced the India's dependence on this foreign capital and has made our market much more resilient. The key message is that, see, don't react only to the headlines. Instead, focus on the bigger picture. History shows that period of fear and foreign selling have often been temporary, while India's long-term growth story has continued. As long as the underlying economy and the corporate fundamentals remain healthy, temporary FI outflow alone should not become the basis for the long-term investment decision, right? So whenever you hear the FIs are selling heavily, don't immediately assume that's the end of the market cycle. History reminds us market reward patience far more often than the panic. And that is an important lesson every long-term investor should be remembering, right? So now I would like to take you to one of my favorite short. It tells us the story of Indian equity market better than any headlines ever can. Now I would like you to show one of my favorite charts because it tells us the story of Indian equity market better than any other headline ever can. If you look at this chart, you will notice that it covers more than 40 years of market history from 1985 to still May 2026. During this period, the BSE Sensex has grown nearly 80 times. But what makes this chart interesting isn't that just the growth, it's everything that happened along the way. Let's start from the left side of the chart. You can see we have seen events like the Iraq Kuwait War, Rajiv Gandhi assassination, Arshad Mehta scam, the Bombay bomb blast, the Asian financial crisis, the Kargil war, the dot-com bubble, the global financial crisis, the lockdown, the Russia-Ukraine conflict, the rising interest rate, geopolitical tension in the Middle East, what we have seen, and even the tariff-related uncertainties. At the time of each of these events, you can see that they felt like major threat to the market. Investors are more worried. News channels predicted prolonged weakness, and many people believed that this time it's different. But today, we step back and look at the bigger picture, and we kind of what we do actually is that we don't see a market that remained down. Yes, we see a market that continued to move higher over the longer term, right? See, every major event created volatility. Some correction lasted weeks, some lasted months, and very few lasted for longer years. But eventually, the market recovered and moved to the new high. If you want to make this even in a much more simple way, let me explain with a simple example. Just imagine you are driving from Chennai office to Bangalore office. See, or like from Chennai to Bangalore. Along the way, you may encounter traffic jam, road diversion, rain, construction work. These obstacles might delay your journey, but they don't change your destination, right? You don't abandon the trip just because your time has kind of delayed by 30 minutes. You simply continue once the road clears, right? The equity market works in the very similar way. Economic growth is the destination, while market correction is simply a temporary roadblocks. As India's economic expands, business grows, the corporate earnings increase, the productivity improves, and over the long period, equity market reflected growth. That's the main thing we need to look at. So the short-term events may slow the journey, but they have rarely changed the long-term direction. That is exactly why long-term investing requires patience. So if investors make decisions based on only on the latest news or the latest crisis, they may end up exiting at the wrong time. Yeah. Interestingly, many of the biggest market recoveries are started when the news flow was still negative. Market are forward looking. We should agree with that. They begin recovering. Okay, see, they begin to recover long before the headlines become more positive. Of course, see, this doesn't mean that market can only move upward. Volatility is like a natural part of equity investing. The future events will continue to create more uncertainty, and there will be always kind of something like going to happen, like geopolitical conflicts, policy changes, inflation concern. or global economic challenges and so. We cannot predict every event, but history gives us confidence that this temporary setback have not prevented India's long-term equity market from creating wealth. So the key message from this slide is not the market are like risky. The message is that temporary events should not distract us from the long-term fundamentals. So over the last 4 decades, the India has faced number of crises. Like the census has compounded nearly 80 times. That's exactly the power of staying invested through the uncertainty. So whenever the major event appears in the headlines, and there will be always another one. You can keep that in mind. So it's worth remembering this chart and see the headline changes, the crisis comes and go, but the long-term wealth creation has historically belonged to the investors who are more patient and remain kind of disciplined and focused on the bigger picture rather than this temporary noises. So we have discussed the India's long-term equity story, which remains strong. But here's an important question: does that mean we should simply invest once and never make any changes? Not necessarily. The challenge in 2026 is not whether equities will create wealth or for the long term, but the challenge is the journey may not be that smooth. Yes. If you see, kind of a static allocation assumes that a market condition remain largely the same. For example, if someone decides to keep 100% in one asset class or one fixed allocation, irrespective of the change in the market condition, they may find themselves uncomfortable when the environment changes. See, today's markets valuation are different across market caps. And if you see the earning expectations are being revised, the global events are kind of influencing the capital flows and the macroeconomic conditions are changing very quickly. Portfolio that was like well suited for one environment may not be kind of equally effective in the another. See, we can go with the previous example, sir. So you know your destination, but the route includes like a highway, traffic stuff, heavy rains, and sometimes even roadblock. If you keep driving at the same speed, regardless of the road condition, you are increasing your risk, right? A good driver doesn't change the destination. They simply adjust the way they drive based on the road which is having the issues, right? So you should know when to make the speed to be increased and when the speed to be reduced. So investing is also going to work in the same manner. The objective is not to abandon the kind of abandon the abandon the equity markets because of the short-term uncertainty. The objective is to make the portfolio more resilient by adopting when the market conditions are changing, whether it's the earning downgrade, volatility spike, of course, FIA stuffs, and other unexpected macro events. So flexibility helps the investors to navigate this space more comfortably. So market will continue to move and uncertainty will be always existing. Rather than relying on a rigid portfolio built for only one scenario, investors should focus on building portfolio that can adapt to the changing market conditions while staying invested for the long-term wealth creation. So far we have spoken about the markets, valuation, asset allocation stuff. Now I would like to talk about something that often has even a bigger impact on the investment journey. That's the investor behavior. Because the truth is, successful investors are not about predicting the future perfectly. It's about making the right decisions consistently, even when the markets become more emotional. Let's look at some of the common behavioral traps that many investors fall into. The first is the chasing recent winners. When the particular sector or a theme performs well, everyone suddenly wants to invest in it. See, a few kind of 2 3 years ago, if you see, it was IT, right? It has become like more kind of like fashion stuff, and then it changed to small cap, then manufacturing, defense, PSU. By the time most investors enter, the large part of the rally has already kind of captured, I would say. They buy the price that have already gone up or not because the valuation still makes sense. See, investing should never be based on what has already performed. It should be based on what makes sense for your portfolio. And the second would be trying to react to every headline. Every day there is some news like interest rate change or inflation, election, tariff, geopolitical tension. Main thing is this oil price or this FIA flows. If we keep changing our portfolio after this every headline, we may end up creating more mistakes than return. Market absorb information much faster than we can react. The third trap is the selling in panic during the market correction. We discussed earlier that correction are normal part of investing, but when portfolios fall by 10 or 15%, many investors exit because of fear. Ironically, this is often when future return potential starts improving. History shows that some of the best investment opportunities have come during the period when investors were more nervous. And finally, many investors ignore the portfolio structure. Instead of building a balanced portfolio, they simply keep adding investments based on tips, recent performance, or market excitement. So over time, the portfolio becomes concentrated without making them to realize it has already been. So now let's look at what successful investors should actually do differently in this particular situation. Instead of investing based on the emotions, they invest according to a plan. Markets will always fluctuate, but the investment goal usually don't change. A good financial plan acts like a roadmap that helps them to stay focused during the both good time and the difficult time. Second would be the rebalance instead of reacting. If one asset class performs exceptionally well and another underperforms, they don't chase the performing one. Instead, they review their allocation and gradually bring it back in line with their long-term strategy. This helps to maintain discipline and a controlled risk. The third could be the kind of they invest continuously through SIPs and additional investments when the things become appropriate. Even during the periods of market weakness, rather than seeing correction only as losses, disciplined investors often view them as opportunities to accumulate quality assets over the long term. And there are always they will always ensure that their portfolio remains aligned with their financial goals, not with the market emotions. Whether the market is optimistic or pessimistic, the question should be always be, is my portfolio is still helping me to achieve my long-term objective? So if I had to summarize, you can keep simple. Successful investing is less about predicting what the market will do next or more about controlling how we respond to the market. So no one can consistently predict what's going to happen in the market, but every investor can choose to be remain more disciplined, follow the process, avoid emotional decisions, and stay committed to their long-term goals. And in long run, if you see the discipline and consistency will outperform the prediction. So far we have discussed about the market outlook and why flexibility matters and why investor behavior is often more important than prediction. So the natural question is now is that who this peer must actually design for. If you see Spear, it's not built for investors looking to chase the next hot sector or predict the next market move. Instead, it's designed for investors who understand the wealth is created through a disciplined investment process over time. First, Spear is for long-term investors. These are investors who believe in India's long-term growth story, but also recognize that leadership within the market keeps changing. Sometimes large cap leads, sometimes mid, and other time like gold or fixed income may play an important role. Rather than relying on a single asset class, Spear aims to provide growth exposure through a diversified and dynamic approach. Second, Spear is for investors who are aware of market volatility. Every year, markets experience uncertainty, whether it's global event, interest rate changes, earnings downgrades, or geopolitical tension. Instead of trying to predict each of these events, Spear is designed to help investors to stay invested while managing the journey more comfortably through a dynamic asset allocation. Finally, Spear is for goal-based investors. The focus is not generating excitement every month or chasing the next best performing asset. The focus is on building a portfolio that remains aligned with a long-term financial objective. The investment decisions are driven by a structured process rather than the emotion or the market headline. So the message behind Spear is very simple. It's not about predicting where the market will go next. It's about building the portfolio that can adapt as the market evolve. So if Sphere is designed for more value discipline over prediction. The next question you'll be getting is that how does the investment process actually work? See, the philosophy is very simple. Process beats prediction. Instead of trying to forecast every market movement, Sphere follows a structured investment process considering three steps. Observe, decide, rebalance. See, first we observe before making any portfolio changes. We continuously monitor the key market indicators such as the overall market backdrop, valuation across different asset classes, market volatility, prevailing trends. The objective isn't to react to every news headlines, but to understand whether the investment environment has meaningfully changed. The second step would be decide based on this observation, we evaluate whether any action is required. Sometimes the right decisions is to add exposure when the opportunities emerge, and other times the best decision is actually to wait and avoid unnecessary stops. And one of the biggest mistake investors make is believing they must always do something. In reality, disciplined investors also means knowing when not to act. And over time, market movement naturally change portfolio allocation. Rebalancing helps to bring the portfolio back in line with the investor's risk profile and long-term investment objective. So this ensures that the portfolio remains aligned with the original financial plan rather than being driven by short-term market movements. So Spear doesn't rely on predicting where the market will be next or like in future. Instead, it follows a repeatable, disciplined process that adapt to changing market conditions while keeping investors focused on their long-term goal. And now let's look at how Spear is actually designed and what makes it different from the traditional investment approach. As I said earlier, at the core, Spear is a dynamic multi-asset portfolio. Instead of remaining fixed to a single asset class, it has a flexibility to allocate across any asset class from 0 to 100%, depending on the prevailing market environment. The objective is so simple, not to predict every market movement, but to make informed allocation decision through the disciplined framework. So the first layer is signal-based investing. If you see, we'll be keep on tracking the market valuations. We see different metrics like VIX, market momentum, and so we have a macro-aware framework also, as markets are influenced not only by company fundamentals but also by the broader economic factors such as the growth expectation, interest, inflation, global stuffs, and so. So Spear incorporates this in the macro development into decision-making process rather than looking at the market in an isolated manner. And we are more adaptive based on the overall assessment. The portfolio has been flexible to adjust its allocation across different asset classes. This allows the portfolio to respond to the changing market condition instead of remaining more static through the cycle. And the main thing is always the focus is always on the outcome rather than the prediction. The objective is to participate in the long-term market upside while seeking to manage downside risk during the periods of uncertainty. No investment strategy can eliminate market risk or risk kind of guarantee returns, but following a disciplined having a kind of more structured way can help to investors to navigate this different market environment more effectively. Um, so what role does it actually play in an investor's portfolio, right? So the role of Sphere is not to replace equities, but to help investors to stay invested in equities more effectively through a different market cycle. At its core, Spear maintains a good equity-led portfolio because we continue to believe that equities remain one of the best asset class for long-term wealth creation. However, we discussed throughout this session that market don't move in a straight line. There are periods when valuations are more stretched, volatility increases, market conditions become more uncertain. During such phases, Spear has been flexible to adjust exposure across different asset classes instead of remaining more completely static. So the objective is to not predict every market top or down or the bottom. Instead, it's to participate in the market upside when opportunities are favorable while seeking to manage downside risk more effectively. As shown here, Spear follows four guidelines: participate in the growth, adapt to the changing market condition, maintain investment discipline, and manage the downside risk. So these four elements work together with the one objective: long-term wealth creation. If you see, ultimately, what Spear tries to do is to quite simple. It helps investors to stay investors, avoid unnecessary reaction to the market noise, keep decisions systematic rather than emotional, and adapt to the portfolio as market conditions evolve. Because see, investing, the biggest challenge is often not finding the best performing asset. It's staying invested long enough to benefit from the compounding. That's a key thing, but still it need to be made much more important. So Spear is designed to make that journey more disciplined, more flexible, and hopefully more comfortable for the long-term wealth creation. And we operate in the landscape from conservative to moderate level, as we have more risk management oriented product where we can have a good exposure towards the equity, but still risk management plays a key role in the product experience. And when it comes to PMS as a whole, as per SEBI mandate, even for Spear PMS, the minimum investment horizon will be 50 lakhs. And the benchmark, what we have for Spear is NSE multi-asset one. When I talk about the benchmark for Spear PMS, the NSE multi-asset one is made up like 50% of NSE 500, 40% of Nifty 50 arbitrage, and 10% of retirement. We don't have any exit load in the product Spear. And the fees what we charge for Spear would be 1.5%, which will be charged on a quarterly basis. And the investment horizon for the to see a good return in the product like Spear would be from 5 to 7 years. As I discussed in my session that as we are more dynamic asset allocation product, we can go from 0 to 100 in any asset class. We don't have any kind of mandatory requirement to have minimum this much in this particular asset class and so. But as a whole in set kind of single stock exposure, it will not cross more than 25%. Well, this is the team behind the products in our ithought universe. Thank you guys. It's a great pleasure you guys attended this webinar during this Saturday time. Thank you guys. We can meet in the upcoming webinar. Thank you.